What do you make of today's price action?
The market is discounting what the Fed wants, right? The Fed is taking out 4 areas of speculation: growth stocks, IPOs, crypto, and ultimately SPACs. And so they want to deflate that because there's been excesses there, right? So the market, particularly in, the averages actually don't tell the story. If you look at the NASDAQ, it's down, but if you look at, I think 50% of the NASDAQ is down 40% or more. So there's a lot more carnage under the surface. I think that the Fed probably is okay with that. I think the real thing that we need to focus on is Wednesday, right? Wednesday, they need to thread the needle on the mortgage market. Right now, they're still buying, 40 billion of bonds per month. Do we really need that when housing starts at a 15-year high? Home prices are up almost 20% year over year, and so they need to decelerate the growth in that market. And so that's very different than what they're doing with rate increases. Rate increases are tightening of financial conditions. The balance sheet of the Fed has gone up 100+%, right, Alex, from 4.2 trillion to almost 9 trillion. That's excessive in a world where we have vaccines, economic growth is strong, and savings is okay.
Henry, good morning. It's Guy. Are you saying you think the Fed may act this week to start maybe to reduce some of this risk, that we may actually see action now rather than March?
I think it's no. I think it's more important what the Fed has been saying. And they went on a major pivot that started in December. Equity investors have taken the longest to catch up with that, but they're seeing that, and that's why those speculative areas are getting hit. So if you're the Fed right now, you're 4-0. But the next 2 games are really important. Number 1 is getting the mortgage market to ease up a bit, and then the final one is wages, right? The structural inflation push that we're seeing is coming from 3 areas: wages, housing, and then the energy transition, which is unfortunately a very noble goal, but it's actually inflationary along the way. So Wednesday, they're going to talk about the mortgage market and signal what they want to do. And my view is that the Fed is right to back off. We don't need to be buying bonds to support the housing market. That was a pandemic policy that doesn't hold water in today's market. And then finally, on wages, I think at KKR, look, we own over 200 companies globally. We have a pretty good window into employee behavior pattern, and you're seeing a couple of things right now. One is wages structurally are going up. They actually were going up before the pandemic, but that's accelerated because of a lot of retirement as well as job displacement related to COVID. And then the second thing is ultimately, I think that we're going to be in a period where housing remains strong and commodity prices remain strong. So the Fed is going to have to figure out how to kind of break longer term inflation expectations. It's doable, but it's going to take some time.
Especially because the Fed can't really help the wage situation, and that they can't create more humans to take jobs in terms of a labor shortage. They can't help with the energy transition part of it. Where do they look for the stress? And I'm wondering, because the credit market doesn't seem to be reacting in the same kind of fervor as the equity market. So does the Fed then feel like they can do more stuff?
I think the Fed's going to do 3 things. One is they're going to start to signal they're going to raise rates. 2 is the balance sheet, as I mentioned. And the 3rd is they can do other macro-prudential measures, things around swap lines, things to make the dollar stronger that tighten financial conditions. I think you raise an excellent point on the difference or the dichotomy between the equity market, particularly the new issue market, with the credit market, right? We own an insurance company. We fund lots of different portfolio companies. Credit spreads are actually okay because guess what? Unit volume's going up. Most companies have pricing power and they've got productivity. So their profits are growing in excess of the wage increases. Not all of them. That's why we think this market is going to bifurcate into the price makers versus price takers. But ultimately, the Fed can't control the employee situation. We're short workers in the U.S. And some of that goes back to policy, what happened in Europe versus what happened in the U.S. Europe went to more of a furlough system. The U.S. Ended up laying off a lot of employees, and it takes longer to get those employees and incent them to come back in the workforce. So there's to me, the other thing I would just highlight is it's very typical to get to a 10 to 20% correction around Fed tightenings. That's what typically about 10%. But when you look in 2018, when we changed the balance sheet, the market almost went down 20%. So, we've had some pretty good periods. The market's up 100%. Volatility is here to stay, right? We've got to right the ship on inflation. Our view at KKR is that inflation is going to be at a higher sustained level, but you can invest in that. Real estate, infrastructure, asset-based finance, some of the other things we're doing in the private markets, and that's what we do with our balance sheet, right? We're the largest investor in what we do, and we positioned it to, I think, traffic through what's going to be a bumpier period.
Henry, it sounds like the Fed's got a lot of work to do. If I take a look at history, when it starts down this road, at some point, if they're tightening this aggressively, it ends up in a recession. Are we heading to a recession, and if so, when?
I don't believe we're heading to a recession. Our models do suggest much slower growth in 2023. They don't point towards recessionary conditions. For that to happen, I think you'd have to have high energy prices, credit spreads, tank, and then the labor market would actually have to see a real tick up in unemployment. That's not what we're forecasting. We certainly are forecasting a bumpier road and slower growth, but not a recession. If the Fed over tightens, I mean, to me, I would go more aggressive on Wednesday, but I would also keep some powder dry for the second half of the year and into 2023 when we do think growth is going to slow. You want to tighten right now, not in 2023 when growth is slower. So I'd come out with guns a-blazing, and then I would back off when you have a way to see what the economy is doing. KKR is one proxy, but our world would show that growth is going to decelerate into 2023, but there's still going to be positive momentum from an economic standpoint.
Okay, so can you put that all in context for what you do as an investor? You still have a lot of money to put to work. Where is the opportunity? In the midst of the market turmoil, where do you buy stuff?
Yeah, it's a great question. One is Asia's cheap right now. Two is there's good value in some of the value stocks. Three, for what we do, we're very excited about what we're doing across our longer-term private equity, infrastructure, real estate, and asset-based finance. Those are all things that have pricing power. Go back to what I said earlier. That what's going to define this cycle is going to be that real rates lag, commodity prices stay higher, and wages stay higher. And we've got a $23 billion balance sheet where we're tilting it towards those areas, and I think we're going to be successful, and we're asking our investors to come along with us. So expect more volatility, have sound capital structures, lean into dislocation, and don't be in capital structures that are speculative. And that's what you've seen certainly in some of the IPO stocks and some of the SPAC situations.
Henry, how nimble can you be in this kind of environment? How often do you guys meet to make the big decisions? How quickly can you react to what looks like a very fast-changing landscape at the moment?
I mean, we've been preparing for this for some time, and I think ever since the policies were announced in 2020, we started to shift our asset allocation. We do have pools of capital that are opportunistic, and that's a growing part of the firm. Same thing with our growth and infrastructure. But what we're trying to get right is long-term themes. When you think about pricing power, collateral-based cash flow, digitalization, life sciences, retirement, we bought an insurance company because we're bullish on savings because rates have been suppressed. Those are all things that are 5- and 10-year bets, but we've got multiple billions of dollars of dry powder that we can deploy into this dislocation. And I think you raise a very good question, which is the public markets in some instances right now are becoming cheaper than the private markets, and you're starting to see a pickup in LBOs and public to private. So there are lots of different ways to play, and we're going to probably be using all our tools over the next couple of years to do that. But we should all be aware, we're leaving, this is a regime change, right? We had March 2020 through November of 2021 was a very strong, somewhat speculative rally. And now we're moving to a period that's much more akin to kind of 2004 to 2006 or 2007. It's much more of a grinder market, more volatility, earnings matter, and pricing power matters.
Henry, before we let you go, we have shop after shop coming out and saying that the risk to the Fed is they actually do more. You seem to think that they need to come out blazing, like you said. What's the risk that they actually do something on a Wednesday?
I think the key is, I think they're going to they're already starting to jawbone the market. The market is selling off in anticipation of the Fed. So I'm not sure they have to start on Wednesday. The key thing is the policy. And the area within what I laid out is the balance sheet. That's the area that's out of bounds right now, given what we're seeing in the housing market. We own lots of different windows into the housing market, given that we're a long-term investor. And what we're saying right now is that cooling that is the Fed's best initiative. So, I think they're different tools they have. I think they'll come out with a strong message, but I don't see them doing a 50 basis point hike. I don't think that achieves what they want on the longer term. And look, the Fed is solving, right now we're talking about today, but the Fed is solving for 2023. Remember, most rate hikes take 9 to 15 months to flow through the system. So let's avoid the noise, focus on the long term. We'll all get through this together, okay?